All right, hey everybody. What is that bright orb in the sky today? After a few days of rain, I don't know, but I sure am glad to see it. So as everybody is jumping on here, hey, good news. We've got some early bird catches the worm questions that have come in, which is awesome. And we will get to those. Gosh.
I have an announcement to make, though, if you don't mind. This is going to be my last appearance because I've been busy with GameStop and with the AME. And so, at 1,700% increase, see ya. Oh, caveat. I need all of you to continue your gaming and step it up and then start going to the movies. Socially distanced, please.
What the heck is up with the GameStop thing? That is a weird thing. I don't get it. It's above my pay grade, that's for sure.
Keeps on going back to a complete disassociation between what's actually happening in the stock market.
I guess, man. Whew. Wow. So, Vicky and Mike, you have been, pretty constant in getting in those early questions, which is good. So we will make sure that we get you guys in early. Anybody else? Pretty much everybody on here, I'm assuming, knows the drill, but just as a reminder, hit the Q&A for questions, harass us in the chat. And, so Adam, Jack, who wants to jump on first with some of the diatribe?
Sure. Welcome to my basement. My lovely bride is remodeling our bathroom herself. So there's intensive banging upstairs. So you get to see the snooker table right over here. So I thought I would shelter you from that so Gary didn't have to mute me. But, kind of this week, I think the only couple things we've really seen this week, at least from our perspective, is a lot of people still have questions about the employee retention credit. And they're not asking questions about FFCRA. So I just thought I'd spend a minute just saying that for most of our clients, the employee retention credit, even though you can use it with PPP, you didn't qualify because you had to demonstrate a revenue reduction. And that revenue reduction, varied between 20 and 21, and it's based on a quarter by quarter comparison. So unless your revenue was down by the criteria, which I think was 50% and then 20% respectively, whether it was 2020 relative to 2019 or 2021 relative to same period 2019, that one's out for you. So it stinks, but that one's out for you. However, anytime anybody's asked me about the employee retention credit, I remind them that, well, look, whether you're down or not, you still qualify potentially for the FFCRA credit, which is the credit associated with participating in the Family Medical Leave Act, which basically means that, if Gary calls me tomorrow and says, hey, Boatsman, I got COVID, I got to be at home quarantining for 10 days and I'm not feeling so great, I don't need to make him take sick leave or anything like that, or be unpaid. I can still pay him. And he still gets his vacation time. That's the piece that I can apply for credit for. But beyond that, if Gary called me and said, hey, my wife's sick, I got to take care of her, check, that qualifies. But the part that I think that, people really need to start digging into, because it is, quite a bit of money, is a scenario where Gary, this isn't Gary, because obviously look at his age, unless he's working on family number 2, this isn't going to be his circumstance, but I don't know. That's a shout out to the clients, and they know who I'm talking about. Well, actually, my own brother had his first kid at 52, so that doesn't say much. But if Gary was hypothetically working on family number 2, and his kids are in CMS, and they're in second, third grade. I mean, this isn't part of the criteria, but having observed people with kids that are below 9th grade, and definitely below middle school, if you're in CMS right now, you're not Like, you're not working. I don't care what you say. I don't care what you report on your timesheet. You're not working. And the thought that you could actually homeschool your kids and then turn around and give me 8 to 10 hours is just disingenuous. So you're just way better off acknowledging that, hey, even though you have the ability to telecommute, circumstances are such that you can't give me the full time that you're working, but I'm not going to make you take a pay cut. That's where the credit can also come into play. And I think that's the piece where a lot of people are overlooking things because they haven't, I think that the whole paying people to not work that know are not working has been sort of the don't ask, don't tell of the pandemic. Meaning like, hey, we're all still trying to do the right thing, pay people knowing that it's a hard circumstance. We're all trying to muddy our way through. But I just, I love everybody that works for us. And I know that we're not getting full time out of some of the people, not to knock them. It's like, I wouldn't know how they would do it either. It's hard enough with freaking teenagers at home, let alone, kids that are younger than that. So it just, that's an overlooked piece of the credit. Related to that, a lot of people say, well, what do I do then? Well, if you have an outsourced payroll company, or just whoever does your payroll, even if it's you basically go back, calculate the value of the credit, and then amend your payroll tax returns for prior years. And the way it shows up is if I could pay Gary, $5,000 for basically sitting on his butt, then I get a $5,000 credit. And that's applied on my payroll tax return such that if you think about it, if I've got $100,000 payroll a month, I roughly am having to pay in, $30,000 in payroll taxes between the employer-employee portion, including withholding plus Medicare, Medicaid. That $5,000 is applied against that 30 is how the money ends up showing up. Tirade complete, Gary.
Hey, that was actually really good because I've heard some of the same sort of questions and you answered it far better than I would have. So
There's credit. Take the credit.
Talk to Adam. Jack, you have any thoughts or things that you've been seeing before we jump into some of the questions?
Sure. So maybe some non-direct PPP related issues, but more business issues just that have come up in questions about. So this one is really directly related to PPP, which is the state taxation of those funds. And there is this concept of income tax conformity, and it's a term that's used to gauge the level of rolling with what the feds are doing on a state by state basis. And so there's different levels, and just, for your own curiosity, rolling, static, selective, and then there's some states like my brothers and sisters down in our Florida offices who have no state income tax to deal with. So there are states that are doing nothing. And so therefore, by default, it is taxed. There are some states that are assertively and affirmatively saying you will be taxed. And then there are others that are trying to, and there are organizations, obviously, that are lobbying to make sure for the state tax laws to be amended to be in conformity with federal tax law, and therefore to implement the intentions of the entire PPP program, which is to not create a penalty, give in one hand, take away from the other, all those things. So there are also discussions about COVID liability protections for employers that are in place. And those are not meant to push away legitimate claims, but it's meant to push away the ones that are, hey, because you were in our workspace and you got COVID, it must have been because you were in our workspace. And, there's no reasonable relationship. And part of that is, what are the employers doing to protect those workers in that space? And if you're showing that you've done what you're supposed to be doing within reason to protect, and you're showing that effort, they're trying to get it so that there is less or no liability for those employers that use their best efforts and then somebody ends up with COVID in the work and as a worker. There is talk about minimum wage increases, which obviously will impact business revenue over the course. And then there is the issue of budget reconciliation. And that's a whole nother topic of things we could talk about. But basically, it's a process that, you know, in case you've heard of it and don't know exactly what it is, it's a way for the legislature, Congress, to basically push something through monetarily related that only requires a simple majority rather than a supermajority. So 51 votes versus 60 votes. And obviously now with it being a tie, with the vice president being the tiebreaker, they can do that, and as well as, you know, the Republicans could have previously, and the Republicans have done that a couple times in the recent term. And so they're threatening that, but not really pushing necessarily too hard on it, because they want to see if there can be reconciliation in other ways and trying to move this forward. So so those are just some topics of discussion that are kind of outside the PPP world, but somewhat related there too.
Yeah, I'm gonna, Gary can already tell you that I'm kind of pissed off today. So to continue with my anger and rage, this is the North Carolina General Assembly House calendar for 2021. We're going to talk about the bottlenose dolphin as a state marine mammal. We're going to talk about the voter initiative for Beaufort County, extend the ABC permit renewal fee.
Some important stuff.
I'm going to be silent. It's like, but we're going to talk about how we're doing all this damage to our businesses by keeping them closed as well. You're right, we are, and at the same time, it'd be great if we didn't have a global plague going on. At the same time, how about some tax relief?
Exactly. All right.
Be like South Carolina. Like, I never thought that I would say, I wish that we were more like South Carolina, but oh, good Lord.
There have been times I've thought about leaving my South Park location and moving across the border.
Seriously.
Oh my goodness. And I hate saying that because I love North Carolina, but there's some craziness going on. All right, so I'm going to dive into some questions. So the first one that came in, we actually have two from Vicky. So the first one is, if you have a loan, $150,000 and above, you have to meet the FTE and salary rate wage reduction requirements. But it looks like if there is a reduction based on FTEs or reduced salaries, it is to be the amount of eligible forgiveness expenses that is reduced, and not a percentage of the total loan amount that could be reduced as we originally thought. Is that right? So if you have a 10% reduction, you apply it to your total eligible forgiveness payroll expenditures and reduce forgiveness expenditures by 10%, rather than I say I don't get 10% of my loan forgiven. Is that correct?
Yeah, I'm thinking, I don't have the form in front of me, but as I'm thinking through it in my head, let me just start by saying that our view at BGW has been pretty much everybody ought to qualify for an exception. So meaning like, hey, we're all, if I had to qualify for the 24-week period, chances are my business was down and disrupted due to COVID. So, I mean, honestly, the only case where I could not stand in front of the court of law and say, you know what, I need to have a reduction, literally, in my own point of view, would be the case where revenues are up, but employee counts down, because I use this as a one-time opportunity to trim my labor force. I mean, that's honestly the only place where I could see where, hey, I probably would not claim an exception because I can't justify that at this point. So all of that said, and I'm talking a long time, so there's maybe a chance Jack can bring up the form in front of him. From what I remember about the form itself, you come up with, well, hey, what were my total covered costs? And then what was my total ratio? What was my total loan amount? And that's kind of my first comparison point. then I think the next thing you do is you've got your total covered costs and you multiply that times the potential reduction percentage. And that ends up being the number that you compare to the loan amount to go for forgiveness, versus it being a percentage of the loan amount. So actually, I thought from what I remembered about the form that it was actually the larger the larger number, and you applied that to the reduction percentage and then compared that to your loan amount. But if Jack didn't have it up, then he can stall and I'll make sure I bring up the form and get the answer.
And I have the form up, let's see, so it is, yeah, it goes into payroll, non-payroll costs, adjustments. So it's total salary, hour, wage reduction, FTT reduction quotient. Then you have to go essentially to the worksheet to do it. So, wow, this form's longer than I remember it was.
Yeah.
All right.
Yeah. So if you want to ask the
Yeah.
second question, we could probably stall for a second here, Gary.
All right, I'm queuing it up right now. As I understand it, loans in the $50,000 to $150,000 range don't have to officially report on FTE reductions or salary wage deductions on the forgiveness application, but they do have to certify that based on their payroll expenditures, et cetera, they are eligible for X amount of forgiveness amount. My question is, they are not exempt from the FTE requirement or salary wage reduction limitation to forgiveness, are they? I know that under $50,000 group is exempt totally, but I'm thinking the $50,000 to $150,000 group may still have to make a reduction in their forgiveness amounts if they've reduced FTEs, et cetera.
Yeah. So I think, let me see if I can rephrase the question. So in this case, we've had a reduction in the FTE count. Is that right, Gary, from the example?
Yeah,
and then I've
so,
also had.
yeah, it looks that way. The question is, they're not exempt from the FTE requirement or salary wage reduction limitation to forgiveness, are they? And this is in the $50,000 to $150,000 range.
Yeah, no, you're still like, you have like the forgiveness, the grant forgiveness is automatic, but at the same time, what you can't do is you can't have laid off everybody and then just said, thank you for the $150,000. But what's supposed to happen is you're not supposed to have all this paperwork that you have to fill out. It's a simplified application, but you're still certifying that you had a need. I think that was the intent of the question.
Yeah, and I would say that it is that the ranges are meant to simplify the reporting process and the forgiveness process, but it's not meant to basically give you, in all cases, a reduction of the qualifications in order to receive the forgiveness, is I guess the best way of saying it, so that it's a reduction in paperwork improving, and they're basically have decided that, well, at less than $50,000, we'll take your word for it. But we can still come after you if you lied. And then there's different standard from 50 to 150, then 150 forward.
Yeah. And can I go back to Vicky's question? Because I've got the form up. So basically what you're doing in the first section, payroll and non-payroll costs, is you're adding up what's all the money that I spent. Then the next thing you're doing is you're saying, all right, well, did I overpay some folks? Or did I have any other reductions that I need to accommodate, which is really just going to be people that I paid over $100,000, or alternatively, if I made people take pay cuts that I need to account for as part of my calculation. I multiply that times my FT reduction quotient. So it's still saying, let me take the FT reduction quotient times the total amount that I spent, which may be more than the PPP loan amount. So I got modified total on line 8. I've got the PPP loan amount times 9 I've got I've got then a max payroll cost that I can calculate associated with that. And then, you know, the lesser of those two amounts is going to be my forgiveness amount. I didn't know this was
Hopefully,
going to be the math. I didn't know this was going to be the math session, Gary.
I know. You are Rain Man. So it's good. Hopefully, Vicky, that answers your question. If not, you know where to reach us. All right,
Okay.
this one's from Mike. Good news. They received their second draw PPP loan yesterday. Awesome.
Good deal.
Question relates to documentation on how they spend the money. So here's a bit of the word problem and then the question. So our first PPP loan, we put all the funds in a separate account, wrote checks only for eligible expenses out of that account. That made it easy for documentation, but locked us into what we could use it for. But on the first loan, we used 75% on payroll costs and spent it all within the first 8 weeks, as this was the guidance at the time. In hindsight, we now know that we could have received more credit through the ERTC if we had used only 60% on payroll costs and therefore spread it out over a longer period of time. So for this second draw, I would prefer if we could just deposit all the funds into the same account as our regular checking account, and then just wait until August or September when we apply for forgiveness to decide what expenses the PPP funds were used for. This would allow us to maximize ERTC credit, which could change depending on our Q1 2021 and Q2 21 revenues, as well as if there are more changes in guidance from the SBA. Well, that wouldn't happen, would it?
Yeah.
Sorry.
Yeah. I mean, so generally, yeah, I would tend to agree with you that, and even in the scenario where, hey, if I thought employee retention credits were still going to be applicable, I would still go backwards and try to use them. So in this specific case, you know, what I think you're asking is, do I have to keep the funds in a separate account and only use them for qualified expenses? When I say no in very simple terms, what I mean by that is it's okay to go ahead and have the funds go into your general operating account. But when you apply for forgiveness, you're just going to want to pull expenses that were associated with the forgivable amounts and make sure that your forgiveness is in the same ratio that you're planning to ask for. So I don't think there's an issue with having them be in your main operating account. Related to that, you know, they did expand pretty significantly the list of expenses that are eligible for forgiveness, ironically, including your CPA. So I guess nobody has an excuse to not pay a bill now, Gary. I didn't
Say
see
that
attorneys
again,
on
just
that
in
list.
case somebody. Say it again.
Accounting services are not considered a qualified expense. Lord knows why, but they are. So
Emotional
anywho,
pain and suffering, I think, is why it qualifies.
yeah, I'm still not
Yeah.
gonna get the I'm still not gonna get the I'm a superhero front yard sign, I don't think. Anywho, you know, so yeah, I don't see an issue with putting everything together in one operating account.
I mean, I think that in previous months, we had said just for being able to easily prove the debits and credits of the use of the money, of the receipt of the money, the use of the money, it was just easy to do that. But it's just as easy to tag it appropriately as to, you know, the funds coming in, you know, with memos and other, you know, general ledger indications. And then, you know, as Adam said, the list of qualified expenses has increased too. So, you know, understand there's a ease of economics or reporting to have it all in one place rather than doing these transfers back and forth. So I think it's more of a ease of comfort and, you know, what is more efficient for you in doing your accounting, whether to keep it separate, but you need to keep it separate. It's just what is the form of the separation is really up to you.
You know, it also goes without saying that, like in this specific example, before getting all super excited, it goes back to the first part of the call about the employee retention tax credit. You know, it was a pretty steep bar for the first, you know, you had to demonstrate a greater than 50% revenue reduction. So we didn't have a whole lot of clients that hit that bar in 2020 relative to 2019. All that said, you know, in a specific calendar quarter. Now, in a given month, it's like, oh my gosh, if I was at a restaurant or, you know, supplier to somebody that was shut down, I mean, there were some pretty significant drops, but some of that rebounded a little bit. But in 2021, you know, they lowered the bar quite a bit to where it's a lot easier to qualify for it. So.
And if I could go back to the question about numbers and calculations, and I was pulling up while Adam was stalling for me, pulling up the actual forms. And so it's if you know, going back to the easy form, it asks you for specific information, and it doesn't ask you for the information that it does in the other applications with respect to you know, it goes through payroll and non-payroll and then potential forgiveness amounts, whereas the S form for the 50 to the 150 goes through let's see, so that goes through the first section as well as the second section, and then obviously the full form goes through everything. So again, my recommendation is to follow the form and the instructions, and I think they've done a better job than they did originally with the forms. You'll see that it's also been modified for first draw versus second draw, at least on the full form. So there have been some modifications. So if you haven't looked at those recently, take another look at them because they have been updated. The main form, the 3508, was just revised less than 10 days ago on January 19th. So do take a look at those and see, reread the instructions, go through the calculations again, just to make sure you got it right and that they didn't switch up something in the middle of the process that may throw your numbers off.
Okay, so this one we get a twofer. One is a question, and the other part is a harassment. So this is from Tom, and Adam, I'll let you kind of figure out what his last name is. But
I looked at the participant list. I know who it is.
So here's the question. I'm a little confused, but no more than normal, around the wording used in the SBA and my bank language in the PPP forgiveness application process. I'm an S Corp, but the only employee. I borrowed less than $50,000 in the first go round of funding. In deciding which form to use, what's confusing to me is the questions around the qualifier. If they ask, am I self-employed with no employees? As an S Corp, do I still qualify in order to use the form 3508S? And second, my original ask was based on 2019 numbers. Now they're asking for documentation of evidence of gross wages. Do I use 2019 numbers or 2020?
Let's go in reverse order. You know, it's funny. They actually said that you could use either 2019 or 2020 for the wages calculation. So, you know, presumably you could go with whatever's higher, you know, if you wanted to use that amount, that way to go. But the reason for allowing people to use 2019 relative to 2020 was really around simplifying getting the money out. Like the intent behind that was, hey, go back to your same bank. They've already got your information on file. This really should be idiot proof. You know, show that your revenue's down. We'll give you the same as last time. I mean, literally, that's what the intent was here. Now, with respect to the form to use, I mean, the point of the self-employment calculation is really just to make sure that you aren't getting more forgiveness than the max amount that was due to you, which was, you know, the 20 some odd $1,000, or, you know, the same as your salary was for 2019, you know, ratably over the 8-week period.
Okay. So I think you answered both of those questions. And here's the harassment. Tell Adam not to sit with the windows behind him. The bright light drowns out how nattily he is dressed. On second thought, it does hide his face and the growth on it. So I guess it balances out. Oh, Tom, come on.
I thought I was just trying to give you guys an angelic glow here. So.
It's going to take more than that, Adam. Okay. This is from Brian. And he says, I'm sorry if the question was already asked. We're applying for PPP2, have an issue with meeting the 25% revenue reduction target. We're off by 2 to 10 points per quarter. However, we have a 12-week window from September 1 through November 30, where we had a 30% year-over-year reduction. The question is, does the SBA allow for the application to designate any 12-week window as a quarter, or does it have to be traditional calendar quarter? In reading the legislation, there's no definition of what constitutes a quarter provided. Any document?
You're right. And in a perfect world, it would be any 12-week period. But the guidance that's come out has said over and over again, calendar, 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 calendar. And even if you have a different fiscal year in, meaning like you're a 630 year in or a 930 year in, they're saying you got to use your tax returns for better proof. So everything that we've seen so far has been, hey, it's got to be a calendar quarter, not in any 12-week period type of comparison. When we say anything that we've seen, that isn't just like the pundits. I mean, that's in the actual SBA guidance that they've sent out. So far has referenced calendar quarter. Who knows why they have stuck with that so far. We did, as I mentioned on the last call, have one bank that said, hey, it's any 12-week period, but they subsequently said, oh, it's a calendar quarter. So even within that bank, they were conflicting themselves. My suggestion would be, hey, if you can get the bank to approve it on any 12-week period, that's great, because they're the ones who are having to submit the request. Secondly, the other thing that I would look at is that, it says that you have as long as you're consistent, you can pick the method of accounting as long as it's consistent with what you use internally. So the other thing to look at too would be accrual versus cash basis, as long as they're using the same comparative, meaning accrual versus cash versus cash, instead of like, hey, I like accrual here, but I like cash back here. You can't do that. And then lastly, this isn't meant to be Shady McShaderson, but the other thing that I'd look at too is, real specifically, I mean, as dumb as this sounds, using BGW as an example, if our invoicing person said, hey, I'm going to take some PTO, I'm going to get the bills done a little bit earlier than I normally would have. That's a scenario that could happen. So what you might also look at is what actually happened right around that quarterly cutoff time period. And is that stuff that would have normally happened in the normal course of things? Or, is that something that, look, in the normal course of things, it technically should have been the next quarter? If I was really close, I'd be looking at stuff like that. In terms of like, look, I mean, if I raise like, $100,000 invoice, and that's making all the difference. And that invoice was raised, on the 31st because my, invoicing person was leaving town versus it really was supposed to be on the 1st. It's just something to look at, since it's really just, an arbitrary date that we're talking about here.
So
I'm not advocating committing bank fraud. I'm simply looking at look at your cutoff points and see if there was anything that was unusual that occurred around those cutoff points.
So I'm going to give you the first question, or it's an ask, I guess, from Robert. Good to see you here, Robert. So I'm going to give Jack a little time to dig into this, and then we'll deal with the question, and then we'll come back to it. But Robert is asking for a run through of the list of qualified expenses for PPP forgiveness, given the changes. So,
good Lord,
I'm ready.
It
Let's
look,
bring it.
yeah, I
You
mean,
ready to roll?
I'll start off with, look, I mean, just pretty much the only thing that it isn't is interest, principal payments on debt. I mean, when I say the only thing that it isn't, meals, entertainment, stuff like that. But I mean, a lot of the stuff that we originally thought it was going to be, and I'll let Jack read it out, but I mean, workers' comp, it's in there, vision care, dental care, other insurance policies, your accounting software, your cloud computing software that you have, cost of goods sold. I mean, it's a pretty exhaustive list that you'd be hard pressed, man, if you can't figure out how to spend 40% of your loot on that. I don't know what you're doing. So go ahead, Jack.
That was actually a pretty good list. So originally it was payroll, rent, mortgage, interest, utilities, and interest on other debts. Now it includes personal protective equipment, certain operating expenses related to business software, cloud computing, property damage costs related to vandalism or looting due to public disturbances that occurred or not covered by insurance, and certain supplier costs. And then you can go into what does those things mean, with respect to operational expenditures, product or service delivery, the processing and payment, tracking of payroll expenses, human resources, sales and billing functions, accounting, tracking supplies, inventory records and expenses, property damage costs, pretty obvious. Supplier costs include things like perishable goods, contracting costs, covered worker expenditures, operating or capital expenditures to the adaptation of the entity's business activities to comply with guidance by the Department of Health and Human Services. In other words, making your office space COVID ready and COVID safe. And then there are other things that under state and local governmental laws that are also allowed. So without going into even more details, that's pretty much the detailed list of things that you can include.
Hopefully that helps, Robert. Next question kind of goes back to the calendar quarter question. So calendar quarter is also true for ERT credit, correct? Do you know whether you can decide when you're using PPP funds, i.e. if you receive PPP funds in February, but you have a reduction of 25% for the first quarter 2021 versus first quarter 2019, could you use the PPP funds in the second quarter?
Yeah. So this is like one of those, hey, when the planets are aligned type questions. All right. So here's my scenario. It's 2020. Like the guidance now is, hey, I can take PPP funds and I can qualify for the employee retention tax credit. So in 2020, first quarter for me, the world ends. Like I'm the Galway hooker and I make 90% of my revenue on St. Patrick's Day. That occurred in the first quarter. I don't know if that's the case, but I just remember, as we're coming up on St. Patrick's Day again, thinking very vividly that at BGW, when we shut down the office, the question was, well, I guess we're not going to Tiber Creek for St. Patrick's Day. I wonder when we'll be able to go again. Probably in a month. I'll let that sink in. So I'm down by 50%. I'm like, oh my God, everything's terrible. I get PPP funds. And at the same time, my revenue is still down and has not been restored to 80% yet. So I'm still in employee retention tax credit strike zone. So in this scenario, let's say that my PPP loan amount was 100 grand and my payroll for the period that I was down, which is, first quarter till fourth quarter. I mean, I was down the whole time, never got restored. Let's say my payroll during that time period is 200 grand. Well, first 100 grand was on the government. Second 100 grand is the stuff that qualifies for the employee retention tax credit.
All right. If you feel like we answered that, great. And if not, hit us with more clarification. So I just got this in from Brian Red over at Pinnacle Bank, and I thought this was pretty interesting because I hadn't heard this from anybody else, but basically he's saying if you applied for a PPP loan last week, chances are you're still waiting for an answer. And if this is your second PPP loan, you're probably starting to wonder, why is this taking so long? So after all, last spring you heard an answer within a day or two and you got your money soon thereafter. Well, what's different this time? More requirements and more paperwork. So applications evidently are universally taking longer for this whole thing. There's more scrutiny from the SBA with less tolerance for mismatches and errors. And rule changes. Qualifications are different. Some organizations are eligible now that weren't in the spring and vice versa. That requires changes in the SBA system and review process, which adds time. All that to say, expectations on timing need some adjusting. Some applications are immediately accepted or acceptable to the SBA because they have no errors, no mismatches, require very little review. Those only are taking a few days. Others are taking a week or more because they have more paperwork, including those required to show proof of revenue reduction. And still more will take longer than that because they've been sent to the SBA and then sent back to us because information was mismatched, et cetera. So bottom line is, if you've already submitted your application, you're in good shape. If you need if they need additional information, they'll reach out. And if you don't hear, expect that your application is making it through. And he said, basically, this is not unique to Pinnacle Bank. And they've been exceptionally good in the past. So thought that might be of value. Okay, good. Mike, I'm glad that that helped. From Vicky, for sick leave, if you give employers 15 days of PTO a year and they're off for an approved sick leave reason in March, can you take the credit, or is the company not qualified if they take PTO time for this COVID sickness?
Yeah, so I mean, this is where Jack's going to help me from getting anybody arrested on the call. You know, the whole point of FMLA when it was passed under the Clinton administration was basically to allow you to take time off, still retain your job, and not have to burn through all your PTO for qualified reasons. So, you know, in this scenario, instead of forcing the person to take their PTO, I mean, you're effectively saying, look, you know, we're still going to continue to pay you, and you can still have that benefit available. That's why you're allowed to take the credit. So to do that, you know, what you're supposed to do, and what we did, and what I would suggest that you do retroactively, potentially, or at least going forward, because it still qualifies for the first quarter, is you basically have to say to your employees, look, gang, if you're having a problem, let me know, because we qualify for FMLA. This is the policy. If you have a problem, let me know. So you can kind of start the clock of what it is that you're using FMLA for, versus making them take time off or burn through their PTO.
All right, hopefully that helps. Another question from Mike. I thought I heard you say for the measure for gross receipts for PPP can either be on an accrual or cash basis. My question is this true for ERTC as well? And by the way, we are C Corp, file our taxes based on accrual.
Yeah, so it's a good question. I didn't check the participant list, but I'm guessing I think I know who this Mike is. So the ERTC was silent, but it would presumably be, you know, just be consistent in the method of accounting. So when I'm mentioning cash versus accrual, that really is only relevant to the extent that you actually have the ability to choose between the two. So in the case where you've got, you know, inventory, or you're otherwise would be required to be an accrual basis taxpayer, I mean, it is accrual by default. So the cash basis question only really applies to companies that have the ability to report their taxes on a cash basis, which generally are going to be service-based businesses or businesses where inventory isn't really material to the business, it's just incidental, which would be like, you know, a plumbing contractor that has inventory, but it's called, you know, a bunch of low dollar value PVC pipe.
All right. Yeah, that Mike is a client. Let's see, we got another one. All right. I think we are done with those questions at this moment. Good questions.
I want to reiterate while we have kind of a lull for a second is to, and I say this, I've been saying this for the past several weeks, is to go to, there's a Paycheck Protection program. I'm sorry, I've kind of been distracted while we've been talking, but I've been trying to find the most recent Cliff Notes of stuff, of, you know, interpretations of, you know, so that way you don't have to go through all the legalese of everything that's, you know, the front end and the back end of all these things that come out to make them official. But really, I would suggest going through to the SBA.gov and look for Paycheck Protection Program. It has a specific subsection for first draw, second draw, a whole section for loan forgiveness, and then has other data. And then when you drill deeper into those sections, there's other links to other information that include, like, you know, to apply for loan forgiveness. It tells you, okay, you know, what kind of documentation you need for payroll, non-payroll, and those kind of things. So frequently asked questions, although the problem with, you need to make sure that you're looking at something that's current, like this FAQ is dated October 2020. So I think one of the downfalls of this is that they didn't do a good job of kind of scraping some of the old information, or at least putting it in a, like, an archive area and then giving you the current information. But like, for example, the forms have been updated on January 19th. So as I said, less than 10 days ago. And so you want to go through, and here's a link to the forms. And so it's a great resource, and it's directly from the source. You know, no one's interpretation, typos in the interpretation or anything like that. This is directly from literally the horse's mouth.
All right, good. Next question is, I know I missed this, but could you shed a little light on ERTC? Just asked to do something on it and know very little about it. What I would say is rewind the tape when we post this today, later on this afternoon, because there's a lot, we covered a lot on that. You want to give some quick highlights, though, just as a recap, Adam?
Yeah, the first people got excited about, now I get this tax credit too. You know, the first thing is you have to qualify. The first qualifying point is your revenues have to be down significantly 2020 relative to 2021 and have not been restored for a period of time. You know, so a lot of people, at least within the BTW client base, we gave the specifics at the beginning of the video, but a lot of our clients right out of the gate, it's like they just weren't down by that much on a quarter comparison. Now, all that said, what I would say is that chances are that if you qualified for PPP Round 2, you're absolutely going to qualify for using the employee retention tax credit starting in 2021, because there the bar got a lot higher or lower. I don't know the direction, but the revenue reduction number is more aligned with the PPP Round 2 funding number, which is a 20, I think RTC, it's a 20% reduction in gross receipts instead of 50% on a 2021 quarterly comparison basis back to 2019. So, the two get aligned in 2021. Why they didn't change it retroactively in 2020, I can't tell you, but it's more aligned for 2021, I think.
So here's a chat. This is from Mitch. So he says, y'all look slimmer in person than you do on YouTube replays. Yeah, there's something in the compression and the expansion of the digital. I guess that's what it is, Mitch. And he says we can come on down to Fort Mill. I guess he's going to leave the light on for us like Tom Bodette down there. That'd be great if we need to.
Yeah, like I got the COVID here. I don't have the COVID there. I got the COVID. That was a bad joke.
That's funny. He said the light is always open for us clowns. So that's good. It's good to know. We stumble around in the darkness enough. We need some.
Well, I will tell you, I'm an equal opportunity offender. I go to the Publix in Indian Land and the Harris Teeter at Blakeney. So, it's all good.
I'll bet you get your gas down there in Indian Land too.
Oh, yes. Mhm. Oh, here's a little information for those of you who buy gasoline for your automobiles. For no reason at all, you can get 5 cents off a gallon at Shell if you just sign up for a card, and you don't have to do anything. You don't have to sign up for a credit card. All you have to do is give them a little bit of information. You get 5 cents off per gallon, like forever. Anyway, when you're filling up your, well, it depends what kind of car you have. I happen to have a Chevy Tahoe that I affectionately call Hank. So when Hank gets filled up, that 5 cents a gallon adds up. So anyway, there's your free tip for today.
Yeah, according to a news flash that came across today, GM is going to waylay all gas and diesel powered engines or vehicles by 2035. So fill that tank while you got it, Jack. All right. Any other questions from the gallery out here? Just as a reminder as well, anybody that had to jump on late, we will post this back up to the BGW CPA YouTube channel. It'll be up probably mid-afternoon. Depends on how fast Rachel can do it by the time she's juggling kids and everything else. But that will be up mid-afternoon. Thank you guys for joining us faithfully. It's always fun to see who is on here. It's always fun to have Adam and Jack in the banter room. So any other parting thoughts, Jack? Or we got another question here. Let's see. Thanks for doing this. You bet, Chris. We appreciate you. Anything else, Jack or Adam, before we sign off?
I think we've covered pretty much everything that we can cover at this point without going way into speculation. So I'm good.
So I'll leave this note, and that is, we seem to have, this has been 10 months of doing this. We started on the 24th of March. It's hard to believe, 10 months of doing this every week. But, we've kind of formed a bond with everybody, which is kind of fun. So if you have, if the PPP stuff starts waning, which we hope it does at some point, but if there are other things that you would like us to be teeing up for live Q&As, topics that would be of meaning to you, that would be great, because I think we're going to continue on doing something as long as there's value and we're providing value to people. So just think about that.
And now you have me on my political tirade here for a second, Gary.
Oh no!
You brought it up then. Now it is actually a fairly serious matter. So we were joking about GameStop at the beginning of the call. I mean, there really isn't a large association between stock market growth and what's actually happening in the economy, and there really hasn't been for quite some time. In terms of like good old fashioned earnings per share and other fundamentals that you use to evaluate stock prices, that's neither here nor there. But where it is really relevant, hopefully we're not due for a market correction or anything like that. But part of the proposed tax changes that are going to come into place are related to capital gains, meaning that if you have capital gains of over $1 million, which it's a good problem to have, but the tax rate, could potentially go up pretty significantly. And I think even more importantly, something that we'll be doing some training around, but is something for everybody on the call to think about and definitely tell your friends about, is that even if it doesn't happen in the next couple of years, it probably will happen in 2025, that they'll reduce the estate tax limitation down from its current exemption level, which effectively means that while there's a pretty high limitation, it's hard to find people that married filing jointly are worth over, $24 million or whatever the limitation amount is. It is a little bit easier to find people that jointly, especially with the closely held family business and the value of that, are worth 6 million. Or when, Gary and his wife both died tragically, not that would happen, their life insurance proceeds create $6 million of estate value. So, all those clients that, we always say, hey, you really need to think about this. And like, well, I'm never going to die. Well, and even if I did die, it's not that big of a tax. Well, it could be, so it is, and with any sort of estate and gifting, time is your ally, meaning the time window between when you actually do a gift and the time that you die. Not that we're wishing anybody to die. The longer that time period is, the least risk you have of it being overturned by the IRS. So it's a long way of saying, on a down note, to get everybody down before we leave for lunch, take the stuff about gifting seriously this year. Like, make your New Year's resolution, if you didn't already. Hey, I'm finally going to get my freaking estate in order. And actually listen to the people that have been telling me that I really should think about this stuff.
And I'll second that. We've had a lot of conversations. I think people kind of, not questioning, but considering their mortality and just amped up. Our estate planning lawyers are very happy to be busy, but I think there's a little bit of lack of knowledge as to what can be done as far as the limits go and the consequences of doing it properly or really of doing it improperly, where you might be missing out on some very more efficient transfers to children, to grandchildren, to your other beneficiaries over the course of time. There's also, we've had a lot of discussion about the interplay between the informal estate planning that occurs within an operating agreement for a business or the shareholders agreement, that then, is there a correlation into the estate planning documents of the individual owner? So you need to consider that as well. You certainly don't want to use the ownership documents, whether it's shareholders agreement, buy-sell agreement, operating agreement, whatever your terminology you're using in your own business, to be your estate planning mechanism for succession in your business. And you really don't want to put your beneficiaries in a difficult position. Have it so that at least with an operating agreement, which most operating agreements, unless it's illegal or against public policy, the terms and conditions of the operating agreement are honored. So therefore, your business partners have little choice but to honor what is in that. But then there should also be the commensurate provisions in your estate planning documents. So that's a long way of saying yes, ditto to everything Adam just said.
So I'm going to leave this on a really good note, and it's very appropriate actually, because it kind of bookends this webinar. So if you guys remember at the beginning of this webinar, Jack said this was going to be his last broadcast because he had invested and done extremely well in GameStop. Well, the good news is, if you like Jack, he'll be back next week because GameStop bubble just burst. So
got it.
Come on, I thought you were going to end it on a good note. I mean,
it's good for the rest of us, Jack. We love you.
I'm too conservative to start playing money on a daily basis. So yeah, it's but yeah, that was a short ride, a short fantastical fantasy ride of making money. So yes, I guess I will have to come back next week.
All right. Everybody, thank you so much for joining us. Adam and Jack, thank you for being who you are and bringing a lot of value to these folks. And everybody else, thank you for joining us. This will be up on YouTube later today. Have a wonderful day.
Thanks,
Enjoy
guys.
the sunshine. See you.
All right.